So there's been a couple of questions coming up about the presentations that you've seen so far today. And we are going to make all the presentations available. We're still gathering them all, so we don't actually have them all right now. But if you check the LendIt website, we will make sure that they're all available. Hopefully by the end of this week, you should be able to get all the presentations on there. And the video, you'll see these gentlemen in the middle, they're video taking everything. This is all, we're going out live to the web, but we're also recording everything. Everything's going to be professionally edited, and you will have, these will be available on our YouTube channel. LendIt.tv will always get you access to the videos for LendIt. So with that, I'm going to introduce Vince Key. He is a CEO and founder of LendKey, and he is going to be running the student loan panel. All right. Thanks, Vince.
Thank you, Peter. So my name is Vince Passione, and welcome to the student lending panel for LendIt. I am the CEO and founder of LendKey. We are a technology firm that provides about 275 community banks and credit unions with a loan origination platform. What I'd like to do at great risk, I was told by some of our panelists, is allow each of them about a minute to introduce themselves and talk about how their particular business fits into the current student lending ecosystem. Starting with Mike.
Sure. So I'm Mike Cagney. I'm CEO, co-founder of SoFi. SoFi is a community-based marketplace that connects alumni and institutional capital with borrowers, primarily graduates. Provides currently student loan refinancing, but also moving into other credit categories as well with the same structure.
Thank you.
I am Brendan McQueen from Tuition.io. It's a platform to help student loan borrowers organize, optimize, and pay all of their student loans. The platform launched last January, and we're currently helping people organize about $1.4 billion.
Cameron Stevens, I'm the founder and CEO of Prodigy Finance. We focus exclusively on the international student side. So we have about 90 nationalities of students in our portfolio at the moment, and we've dispersed about $50 million to students focused on business school degrees and expanding out at the moment.
Hi everybody, David Klein, co-founder and CEO of Common Bond. Common Bond is a student lending platform, and we're committed to making the student lending experience better through a couple different ways. One, appropriately priced finance. Two, our exceptional customer experience. And three, what we like to call our commitment to community. Look forward to the conversation.
Great, thank you. So perhaps a little level set on the student lending environment. 2014 was another big year for student lending, not just because I think Mike did a phenomenal thing and securitized a large batch of those loans, and David was able to raise some significant dollars to go out and originate, but also because of the size of the student loan debt burden in the United States. It's often referred to as a bubble. Right now we hear that number has surpassed about $1.1 trillion. But I think it's important to sort of demystify the bubble and some of the concerns around it. Predominantly the fact that that bubble is being driven by the large volume of federal loans that are being originated in this country. If we take a look, here are some basic speeds and feeds about it. So there are 21 million students that enrolled in college this year. That's up about 6% from prior years. If you look at how those students turned around and funded and went to school, about 5 million of them enrolled in nonprofit four-year schools that average cost of attendance is about $41,000 with room and board, which is up about 3% from the prior year. The balance of those students, about 16 million, wound up in state schools, where in-state tuition is about $18,000, and out-of-state's about 32, which is up about 2.3% from the prior year. If you think about what happened when those students enrolled in their financial aid office, they're all given a financial aid statement where they all signed up for $100 billion worth of federal loans that are not underwritten, but are basically needs-based. Once they exhausted all their federal funding, they went off and went after private lenders to the tune of about $8 billion, bringing the total private loan debt to about $65 billion. So when we talk about the bubble, it's basically been driven by two factors: the increase in college tuition costs and the increase in the number of non-underwritten student loans that are available today in this country. Now, also want to demystify some of the concerns about underwriting and credit quality. So post-2007, the entire landscape changed when it came to underwriting. If you take a look, recently Measure 1 went out and looked at 2013 private student loan portfolio. The average default rate on that portfolio is about 3% across 7 of the largest lenders in this country. Conversely, federal loans, their 3-year cohort default rate is which how students repay 3 years after graduation, somewhere around 14.7%. So the issue truly is increasing college tuition, but also access to federal loans. So what does that mean, and why are these companies relevant? First and foremost is students need a true refinancing mechanism, and there isn't one that was great prior to many of these companies coming on the landscape of the United States. The other is the ability to manage that debt. Now, not to leave Cameron out, the international market looks very, very different. There are no federal loans. Up until about 2008, there were companies who were guaranteeing loans, which has stopped. And now schools, the top schools, are guaranteeing loans, working with credit unions and big financial services firms like Discover. As Cameron points out, it's okay, but it's not perfect. So with that as a backdrop, why don't we start off with where we left off last year. Many of you were on the panel, Mike and David, and we talked about how building community has affected your businesses. And specifically, what I really want to talk about is how community has affected your business now that you started to introduce institutional capital into the mix. Mike, would you like to start?
Sure. So we've funded a little over 6,000 borrowers and about $550 million of refinancing loans at this point. Funded about $72 million last month and should fund about $85 million this month. And so the source of that capital is a combination of institutional and retail. And one of the challenges of going into the student loan refinancing market is you're going to a fixed pool that's primarily at 6.8 and 7.9% legacy rates. So to be able to refinance, you've got to come in with a value proposition that is both economic and community driven. The economic value proposition is tough in that most of you doing peer-to-peer investing are used to car consolidation type investment opportunities where you're getting low double-digit gross yields, and that's an attractive dynamic. So what we have to do is demonstrate that there is a very strong credit cohort here that on a risk-adjusted basis, this is an attractive investment to attract retail capital in. That's augmented by things like securitization. So we did one of the first rated peer-to-peer transactions last year where we took $152 million placed $152 million of senior A-rated single A-rated senior notes, subordinated by about $15 million of equity. And what that allowed us to do was go after the investor segment in a more refined way, where the institutional investors took the senior notes. Those are the asset managers that were doing that as part of their regular investment allocation. Retail took the equity and the subordination, which got them to a low double-digit return and an attractive risk dynamic. We think it's critical to keep the retail component involved because there's a moral suasion aspect. So when you sign up for a SoFi loan, you agree that if you default, it's transparent into the community that funds you. And I think that plays a role in the credit performance that we've had. Of the 6,000 borrowers we've had, we've never had a default. We have no one who's 90 days delinquent right now. It's relatively unheard of for a credit book, a consumer credit book, to look like that. Some of that's underwriting, but some of that is the moral suasion component, addressing adverse selection and moral hazard up front.
David?
Yeah, so what we've noticed on the community piece, it's interesting, you talk about community and it actually sounds quite soft. But it's probably the hardest, most tangible tool we have from an ongoing risk management perspective. Why? Well, it's for two reasons. One, the community psychology actually minimizes default risk. And two, the relationship that we're building with our borrower maximizes our recovery rate in the event there is a default. So on our platform, we've been fortunate enough to date to have 0% defaults, even 0% delinquencies. And we think a lot of the reason for that, in addition to the fact that our thesis is playing out of underwriting credit-worthy borrowers, we think a lot of that has to do with the community that we're building. If I could just give two quick examples. Community psychology, if you want kind of a hard example of how that can play a positive role in preventing defaults, you need to look no further than what Muhammad Yunus did with microfinancing in Bangladesh. Here he is financing to the bottom of the economic pyramid globally, and he's experiencing 95% repayment rates, right? That has a lot to do with the fact that a borrower feels as though they're part of a community bigger than themselves. And so when we at Common Bond are building a community of students and grads who become alumni, who become accomplished professionals in cities all around the country. And we connect them to job opportunities and mentorship and funding for their startups. There's a value inherent in that that many consider to be much more valuable than the $17,300 that we save our borrowers. And so when we start talking about community, it's important to understand, or rather take community seriously as a real lever for an underwriter or a lending platform to pool.
Cameron?
Yeah, and I think just to add to that, I think we all feel the same about that moral suasion aspect. And we've seen that play out in multiple times with people getting quite frantic in being late for a payment and understanding what that will do in their status. For us, it was even more important because we were addressing, compared to Common Bond or even SoFi, we were addressing a sector which had far less data and was a lot more fragmented. So in the early days when we were looking at it, you didn't have the same amount of data as you would in a refinance pool, but you have this amazing community around the school who can think about that risk. So for us, when we think about the student from Ghana or the student from India going to Harvard or Stanford, for us and for the alumni of those institutions, that's it's a risk that they can appreciate, that they can understand, but you don't have the same level of data to be able to prove over 3 decades, this is what it looks like. So for us, the community aspect has driven all of our funding to date. That will change as we scale up. But it's been important both for the moral suasion, but critically important for us for the funding and being able to prove out the model so that we can show, here's the hypothesis, and actually, hey, look, this is how it works, because you've got a group of investors who really understand the risks in the early days.
So as we think about the model and how it scales, from the very beginning, we talked about alumni-funded loans and that community. But as it becomes more publicly aware that institutional capital is filling in the pieces to get scalability, how do you think that affects things like, A, getting to other products and services, B, your customer acquisition costs? Because many of you enjoy very low costs. I mean, Mike, last time you spoke, your costs were as low as $200 a loan, which is significantly less than what Sally Mae would pay. So as that becomes more public, what do you think the impact will be on that community for you?
I think the key is you have to maintain the value proposition. And one of the things that we focus on, if our borrowers lose their jobs, we go and get them reemployed through the community. We've done it 28 times for borrowers. If someone wants to start a company, we help them raise capital through the community. We've done it 19 times for borrowers. People talk about that, and it engenders a lot of goodwill and a lot of enthusiasm around the platform, and that's what drives virality, that's what drives referrals. Over half of our business comes in through word-of-mouth referral, which is why our acquisition costs are relatively low. So I think when you maintain the integrity around the value proposition on economics, so you're lowering their loan rate, delivering something tangible there, but you're also maintaining the community commitment, being everybody's in this together. So if someone loses their job, the phone call isn't calling up and arguing and saying, when are you going to pay us? It's, hey, how can we help you get reemployed? And having folks participate in that process. And that's why, even as we've introduced institutional capital, we've done it in a way that rather than doing wholesale loans or selling whole loans to a bank, we have banks participate on a fractional interest where we can have alumni and SoFi money side by side, pari passu, to keep that thesis intact.
David?
Yeah, I think this question of is it peer-to-peer, is it retail, or is it institutional, is an interesting one. I do think that I think the genesis of the answer has to do with the value we're providing to both sides of our market, as opposed to a moniker that we give something in particular. And so this question of does it matter? Does it matter if something is peer-to-peer or institutional? I think the right answer lies in, well, how much value are the borrowers on the platform receiving? And how much value can investors, whether individual or institutional, receive? And to date, what we've seen, if we just look at the platforms that come to bear, across the Lending Club and Prospers of the world, the Common Bonds and SoFis of the world, you'll see that a supermajority of the capital is in fact institutional capital. You have a comparative example in the UK where the peer-to-peer platforms that have come up since the early to mid 2000s are predominantly retail investors. And when you peel back the onion a bit more, I think what you'll find, and we've talked about this a little bit, Cameron, in the UK and Europe in general, the regulatory scheme in both countries are actually quite different. And so in the States, where the regulatory scheme is a bit more restrictive on individual capital, to the point where Lending Club and Prosper had to deal with what they had to deal with in '08 and '09 and kind of get over that hump, where we have to deal with certain things outside of filing every single transaction with the SEC and maintaining kind of a limited individual investor base among accredited investors. The fact that our models require scale and speed to operate puts platforms in an interesting position to decide what to do. And I think what you've seen platforms decide to do is scale and speed are of critical importance, and there is a place for the individual investor.
Cameron?
I mean, I think for us particularly, student loans is one of the spaces where the community really does matter compared to Lending Club or Prosper or even Zopa. I mean, when Zopa started in the UK, they were very much talking about the community and what that is. But for me, it rang a bit hollow because it's a whole lot of anonymous people lending to a whole lot of anonymous people. There's nothing really there. You're creating this sort of pseudo community compared to the student loan market, where you genuinely have these communities around these institutions and the alumni networks which are strong. So I think for us, the community, or for the sector, the student loan sector, I think the community aspect has more weight than for other sectors in the space. But that said, it's certainly, I don't think we are of the view, and we probably have the most community funding on our platform, but that scale is absolutely important, and really we're not at the stage yet where that can come purely from the alumni retail. You need the institutional element, and to reach scale, and SoFi has done an amazing job on that, and so have Common Bond. In reaching that scale, you need that institutional capital. So it certainly doesn't need to be 100% community, and equally, I don't think it should be 100% institutional, but those two should play together, and I think that will work well.
Great. Let's flip a minute into Brendan's world. So Brendan, you launched Tuition.io. Right now, it looks like you have about $1.3 billion worth of student loans that folks have aggregated on your site. What have you seen from the data? What are the interest rates they're getting, and what's your acquisition strategy?
Sure. So it's enough people on the Tuition.io platform that we have a pretty good insight into the general market, right? Like, so interest rates on the average tide are just over 6, but they're all over, right? As is income, as is credit. Just under half of our users have credit of over 700. But it's truly fascinating to see that, people on our platform on average have about 7 loans per head, and they owe about 52 grand a head. And it's even more interesting to see the colleges in terms of overall volume on the platform. And you have a ton of private schools, you have a ton of profit colleges on there. So a ton of insight into our users, and that's helpful in order to pair them to products that can help them improve their financial situation, if you will. In terms of customer acquisition, for about 18 months, have put a lot of time and effort into our content in terms of SEO. So that drives a pretty good amount of signups. And they're also offering a scholarship every month. And it turns out that a lot of people who are after scholarships happen to have student loans that they can organize on our platform for free. And we tend to approach this from the perspective of how can we help anyone who comes to our platform and offer them that upfront value add,
Great.
if you will.
So let's talk a little bit about financial literacy on that part. And how important is financial literacy to all of your businesses today? Because certainly the regulatory environment is such that CFPB is pushing very hard for consumers to be educated before they hit that apply button. So why don't we talk about that, Mike?
I think the schools are naturally resistant to this concept, and it sounds very straightforward. If you go and you're in a school and you're going to take a loan out, you think one of the first things that should happen is the financial aid officer should sit down and explain, here's the degree, here's the school, here's what you're going to get paid, and here's how much you can take out to afford it. That conversation doesn't occur, and that's why you have the dynamic that you have. And I think, if you look at folks coming out of school, the undergrads are right around $27,000 in average debt burden. That's not where the actual large debt explosions happen. It's happened in the grad programs. And it's happened in the grad programs because they have what's called a grad plus loan. A grad plus loan doesn't have a dollar cap on it like the undergrad loans do. So a grad plus loan, you can borrow as much as the school says you need to borrow to be able to pay for school. And you create a classic agency problem when you do this, and the result shouldn't be surprising to anyone, which is you have an explosion in grad debt balances, and that's what we're seeing in the market.
Yeah, I would just say financial literacy makes sense across the board, regardless of how you cut it. From an underwriting and risk management perspective, it makes a ton of sense. You want to ensure that the borrowers who are looking to finance their education know exactly what they're getting themselves into. So that's why at Common Bond we built a tool that actually allows you to pull in cost information by school, input your own personal equity and debt situation, to actually project what kind of income you expect to get upon graduation to see if you can afford the monthly payment that our tools shoot out and give you. And these tools could be made by anybody who has an Excel spreadsheet and an understanding of finance. But the point is, not a lot of people are doing this. And so this is something that we'd like to do, is we believe that we see ourselves as a responsible actor in a broader ecosystem to ensure that we as a lender do also have a responsibility, just as the borrower has a responsibility, the financial aid office has a responsibility, the CFPB and the government has a responsibility, to ensure that the borrowers and lenders in this space are providing debt in a way that just makes sense.
Cameron?
I'll take a different view. I think we like to keep our borrowers completely in the blind as much as possible because it gets brilliant margins. So that's our.
I think there's someone from the CFPB in the back there.
I'll certainly retract that. But we go a slightly different way. We're probably the only platform. So we've built a sort of predictive scorecard to assess someone's future earning potential, and we do that with data that we get from the universities. So to really assess what someone's going to be earning with particular characteristics after they graduate, and to be able to give them a debt burden that is affordable. So I think literacy is very important, but I think in terms of assessing what debt burden we are comfortable letting that person with actual data to support that means that we don't end up with someone who just takes on more than they can afford, which is bad for everyone, bad for the student borrower, bad for us, and bad for the investors. So we sort of take it, I suppose, one step further than the financial literacy side, and actually put that into our underwriting decision and into our risk models.
Want to comment, Brendan?
Yeah, I mean, financial literacy is core to our tool, right? People come to us and have a ton of questions, and these are questions that are easy ones, like who do I owe money to? How much am I owing them? And our platform has proven to help people increase payment per month by almost 4%, and has also helped us save people just under $2 million. But if you're talking about the overall picture, colleges are starting to pay attention to this in a big way, and it isn't just the colleges that are having issues in terms of their cohort default rates. You have a ton of private schools, you have a ton of top-tier colleges who are starting to have conversations around trying to be proactive here, having conversations about the ROI of a particular program in their school, and I think that piece of it is core to the future of education lending, if you will.
Okay, let's dig in on scalability a little further. So, You launch a company, alumni are going to fund loans, right? Creates a very interesting sense of community. You deal with the top schools, great. I service $600 million of student loans across almost 2,000 schools, right? So what happens when you get beyond these prestigious schools, right? The alumni, as fertile and as communicative and as involved, how does it work? Mike?
Yeah, you start to run into some challenges as you move across a broader spectrum of schools. And one of the things that we've done is we've liked to keep an anchor point of a certain ratio of community capital for institutional capital, no matter where we are. And that builds some defensibility in terms of the schools that we go to and why we can lend at rates that we can lend at. But at the end of the day, if you're in a situation where you can't go to a school because you can't raise alumni capital, it's really a circumstance of the school charging too much for the tuition relative to the value of the education, that the default rates are too high. You can't make a reasonable after-tax or after-loss argument for a retail investor to come in and participate. And it's a signaling mechanism. It's a signaling mechanism back to the school that you've got something out of whack. And that's how we've approached it. The schools aren't always the most receptive to such signaling, but that's what it is.
So where does it cap you? I mean, there's some 17,000 schools in the United States. Is it 100 schools? Is it 200 schools?
It's not a limit of the schools. It's a limit of the market. I think, if you look at the 1.1 trillion of total debt that's outstanding, there was an op-ed piece that someone wrote the other day, and they made the comment that only 15% of that was in default, but only 30% of that's in current pay. And I think that's a more relevant number to look at. And so you've got 1.1 trillion of debt, of which 330 billion is actually paying right now. The rest is not. It's a pretty tough asset class. And so I think of that current pay opportunity, that is potentially refinanceable. Maybe half of that, maybe it's 150, 160, 170 billion out of the total market that's addressable in the grand scheme of things. But it's the market's changing, and the government's modified their loan rates. Last year, they were much more aggressive on pricing. We actually did not do a lot of in-school lending last year because to us, there wasn't a strong enough value proposition around the economics you would save versus the benefits that you get from a federal loan, which is guaranteed economic hardship forbearance, income-based repayment, et cetera. That'll change this year with rates going back up, but it is a finite market. It isn't that full 1.1 trillion that we can go after.
Dave?
Yeah. So, I think it's less about school and it's all about an ability to repay. If I think about what we're doing heading into the back half of 2014, beginning of 2015, we'll be moving to a model-based underwriting system that takes into consideration, in addition to traditional credit metrics that we're considering today, a whole host of other potential predictors that either haven't really been used in the student loan marketplace yet, or have and just weighted differently. And so, your underlying question is, how big is this market? Do you have to go, I think what you're asking is, do you have to go down the credit spectrum to a point where it doesn't make sense to underwrite? And for us, our strategy is to ensure, like I said, that we are lending responsibly and lending to people who we believe can have, do have, will have an ability to repay. And so that's really what our focus has been up to this point. The second thing I would say is just from a business strategy perspective, student loans is where we start, but it's not necessarily where we stop. We're looking to be a financial services platform of the future. And what that means is, to the extent that we can build a pretty strong relationship with our average borrower right now, who's 31 years old, they're making about $120,000 out of school. Average FICO is about 750, and they're taking on about $75,000 in debt with us. If we can get this transaction right for them at the relative beginning of their customer life cycle, then we believe we've earned the right to provide them with other financial products and services over the next 20, 30, 40 years of their financial life.
So the alumni are going to fund the mortgage?
Could be.
Okay. Cameron, any comments there?
No, I think that certainly the dynamic will change. I think the specifics, as you go sort of, I suppose, downscale, for us we see it certainly for the next couple of years staying in the graduate space. That's where we want to be playing, certainly focus on the international space. And again, that's something that we see, and that's sizable enough to keep us busy for the next year or two. So I think At some point, yes, it does become an issue as your community weakens. But the dynamics also change. If you're thinking about a top-tier sort of community college in wherever it may be, the tuition's also significantly lower. So you've got a different dynamic going on. So I think with the things that we're learning now, and which others are learning now, it's potentially addressable into those different institutions at some point, but it's not somewhere that we want to be playing right now, and there's enough to keep us busy.
Great. We're now on the 10-minute mark, so I want to open it up for questions from the audience. Yep, your question there? Yep.
Thank you. My name is Paul Jeffrey. I have a question for David. David, I was very interested in your comments in particular with regard to the value of community. In your comments, you made reference to Banker to the Poor by Muhammad Yunus, and therein the experiences of Grameen Bank in Bangladesh. If one looks at that, and looks at that experience specifically, what you learn is, I think, that community worked because of the cross guarantees that there were within the groups. Now that cross guarantee aspect is not evident, I think, in your model. So I want to believe in the community aspect of it. I wonder if you could give us a little bit more to hold on to outside of the absence of cross guarantees.
Sure. If you want a more modern for-profit example, I believe that if you look at what some platforms were doing maybe 5 or 6 years ago, in a world in which the online platform was much more community-based, and you dig a little deeper, you find that the default rates were about 50 to 60% less than what they are today. Default rates on platforms as they exist today are still respectable, but they were even better back then. So here you have a more modern example. It's for-profit and attached to what we're doing. There's also a lot of literature out there on community psychology in general, and what happens when you feel as though you're part of something bigger than yourself. You cross-check that against who the traditional players are in this space, in the federal government and the private banks, who are generally considered from a borrower's perspective to be pretty much a black hole, and borrowers feel as though they're a rank and serial number. We've had borrowers tell us, unsolicited, one of the reasons they love being part of our platform is that we treat them like a human being. Who would have thought that a borrower on a platform, the greatest form of compliment is that we treated them like a human being? And so I guess the way to put this is that, community can't really be a strategy for a company. It's got to be the soul of a company. And if it's the soul of a company, it starts with the founders. And then it's a prerequisite for every single hire that you bring on board, such that when the folks in your operations department are dealing with people and making that phone call 24 hours after the application, and they're having a real honest-to-God conversation, there's a true face and name behind the conversation and behind the lender, as opposed to any kind of big black box where the borrower doesn't feel as though they're part of anything bigger than themselves that they want to belong to. So that is something that I believe we're doing. That is something that I believe is where the future of finance, at least in part, lives. And that's something that I get really excited about.
Thank you. Other questions? Yes.
Hi, I'm Christine from Shanghai Lufax. I have a question for Cameron. Cameron mentioned something about looking at you offer a debt burden ratio that the student is capable or acceptable to pay off. How do you look at that when the student is still studying and he has nothing to underwrite about? Can you tell us more about that?
Sure. So, it was one of the things when we started Prodigy, just thinking about, and one of the things that the banks do very badly in assessing. You're trying to assess someone's future earning potential, not their current income. It's particularly important for us, for guys coming from, wherever it might be, South Africa, Chile, India, who come in to study at a top university. They're going to experience a significant shift in earnings potential. How can you assess that well enough to really base a loan decision on it. And what we do is we partner with the university. We get thousands of data points from the university over the last decade or more to understand what are the earnings of graduates from the university linked to the entry profiles of those students. So what we can assess is, in a quantitative way, that someone with these specific characteristics in their profile is going to end up in a particular earning band. So we can effectively predict their earnings potential, not to exact salary, but at least to a significant band, and then we can make the loan decision based on that. And that's helpful for the student in giving them enough to make a difference that they can borrow, and it's helpful also not overburdening them with too much debt, so that we can make a very robust lending decision in doing that. So it's data-driven on us. We build a scorecard, and we calibrate it for per university.
Time for one last question. Yes.
Hi, my question's for Mike. You mentioned earlier how the schools that might want to participate in your platform don't exactly like the feedback you give them if you come to the conclusion that their graduates don't make enough to make the monthly payments given the amount that they're charging. Do you think what you're doing could potentially influence repricing strategy by certain private colleges whose graduates don't make a lot as other elite private colleges? And could it have an effect public policy overall in tuition pricing?
Yeah, and that's what I alluded to around the signaling. I think that there's a very strong signaling component that comes out of schools where we can operate successfully and schools where we can't. And I think that folks have started to look at that in a very interesting way. The idea was that you would get alumni suasion, so basically the folks that matter the most to the school, to push on, hey, we're graduating individuals with debt loads that don't commensurate with the value of the education year, and that's why our default rates are higher than places around us. It's just the schools are very, very reticent and dogmatic about taking that information into play. And in particular, when you start getting into the nuances of the likelihood to repay across degree type within a single school, it's met with even more resistance. People don't want to acknowledge that computer science majors have a higher propensity to pay their loan down than psychology majors do. And so I think there's a lot of work to be done there, but it's an uphill battle. And I think that the government's taken some steps towards this. They didn't go all the way towards a know before you owe process, which is what they had talked about. They have a college scorecard system, which is okay, it's kind of halfway there, but at the end of the day, what's really needed is, before you take a loan out, someone needs to sit down and say, this is how much you're going to make and how much you can borrow to be able to pay it back. And until that happens, you're going to continue to have this problem, and it'll be exacerbated by Grad Plus loans, which have no ceiling. So, and that's, again, why you've seen the explosion in grad school debt.
Terrific. Well, listen, thank you for attending our panel on student lending. A big round of applause to our panelists.